Rising oil prices lifting Wall Street for a second day Tuesday. Growth stocks again leading the way, but is it time to switch to value? Well, let's ask Nick Cullis, co-founder of DataTrek Research, and he joins me from New York City. Welcome, Nick. So before we get to growth versus value, let's take a look at today's markets. It looks like the pattern since March 23rd is one step back, two steps forward. As you see it, is a bias still on the upside? And if so, have investors factored in a possible second wave of this coronavirus pandemic?
Yeah, no, it does seem very much that markets feel they understand the basic contours of the problem and have seen governments step in, both in terms of fiscal and monetary stimulus, to give us a shove in the right direction economically. As for a second wave, I do think markets understand reopening comes with risks, and we are going to see some elevated cases for sure as states reopen. But at the same time, I think everybody understands that process has to at least start so we can learn and adapt and continue to get the economy back on the right footing.
All right, let's go to your blog post about growth stocks versus value stocks, a time out here to debate. You point out that big cap value stocks narrowly outperformed big cap growth stocks since March 23rd, but the opposite happened for small caps in both categories. Give us the context of your study.
Yeah, it's a classic debate, as you mentioned, growth versus value, and there are adherents on both sides of the coin. Growth has had a tremendous run over value now for the better part of 10 years, particularly in the last 5 years. And what we found was looking at how these styles have traded from the March 23rd lows, value did get a small bump in the first week after that low, and that was the financials coming back to life and a couple of other beaten up groups. But ever since then, it's been growth, and it continues to be growth outperforming value for all the reasons one would expect. Tech stocks are mostly growth. If you look at the S&P growth sector style, what you're looking at is 38% technology. You're looking at 14% cyclicals. But at the same time, Microsoft, Apple, Amazon, Google, they're all big chunks of that index. And so naturally, it is doing better.
So is it possible to conclude that growth, or should you, when it comes to investing style, do you invest in growth versus value, or do you invest based on sectors? Because I think your study showed that small caps showed a different result.
Yeah, small caps, value had done a little bit better in the first 5 days because financials are 25% of the Russell 2000 value, and they did get a bounce. But at the same time, ever since then, growth has really done better because healthcare is such a big part of the Russell 2000 growth index. The underlying point is one that I think you began to touch on, which is you're not really investing in styles anymore. You're investing in entire sectors. Do you really want to be invested in U.S. equities without owning at least some Microsoft, Google, Apple, Amazon? I would answer no. Does that mean that you have to be a growth investor? Equally no, but you have to understand these indices are now so skewed that they're in many ways almost uninvestable, particularly on the value side, because they're missing so many important names.
So if it is style versus, or sector over style, what sectors would you bet on right now?
We still like technology. That's been kind of a core holding for us for the last 2.5 years. And I was looking at the S&P technology sector. It's actually up on the year as we go into the final couple of hours of trading. So technology is coming back harder and faster than most sectors. And we still like it here. We get the valuations are rich, but it's a sector that really hits on all the themes that we see every day now.
Not healthcare, despite, all the news about the coronavirus pandemic, the search for a cure, the search for a vaccine, and today Pfizer and BioNTech are upriding on that, the fact that they're testing on humans now.
Yes, the issue with healthcare is a different one, and that is that it is right now about as much of the S&P 500 as historically ever can be at the top of the healthcare cycle. It's roughly 16.5%. Typically speaking, healthcare underperforms in the year after it hits these kind of levels. So I think we're looking at some enthusiasm for the topics that you raised. Totally correct, and some stocks will continue to do well, but as a sector, it feels very tapped out in terms of relative valuation to the market.
All right, so bet on sector over style and tech over healthcare.
That's right.
All right, thank you, Nick, for your thoughts. Our thanks to Nick Cullis of DataTrek Research. I'm Fred Katayama, and this is Reuters.